Hi everyone, this is Nisha Golcha. I'm the corporate tax leader at Brainfood Jenks. Welcome to Brainfood Bytes. And today I'm here with CalCPA to talk about some fun tax planning around corporate giving and how it impacts corporate tax planning. So let's dive right in. So before we get into it, we're going to talk about the one big beautiful bill. Just a caveat. We want to talk about some macro trends in corporate giving. So corporate giving has had some interesting, patterns. It has been on a decline for, after pandemic, but we saw a real steep increase in 2024 for about 592.5 billion. It's a big number in 2024, which went up by 6.3%. Even if you adjust for inflation, it was still pretty high trend. Especially corporate giving increased by 9.1%. And it was a first, double-digit, almost close to double-digit growth, one of the fastest growing categories that we saw in charitable contributions. And part of the fun fact could be that part of the surge was fueled by strong equity market, with many, companies donating appreciated stock. Fun fact that if you donate appreciated stock for a donor, you get double tax benefit. Talk to your CPA about how do you get there. I want to focus, shift our focus on the last two trends, which shows a real paradigm shift in today's workforce. Which expects more, purpose, not just paychecks. And 87% of corporate leaders say that their employees expect the companies to support causes that matter to them. And 70% of employees say that it is imperative or very important to work for a company that supports giving and volunteering. What does it say? It says that, corporate philanthropy has moved from being optional to, expected. And with some tax planning around it, effective programs can combine employee participation, community relevance, and tax efficiency, and package it all in one deal. So it all starts with planning ahead. So let's talk about how do we do that and what are the things that we need to be aware of. We will talk about the one big beautiful bill today and how it impacts corporate giving. So it's a general reminder that even generosity, needs strategy. So with these new rules, the two highlighted red sections are the ones that have been introduced by the bill. Other than that, the key components still remain the same. It's if you donate to a qualified 501c organization, and you get deduction about 10% of your taxable income. Anything that's above that can be carried forward for 5 years. If you're a loss-making entity, you cannot claim a tax benefit. Easy peasy, but the twist in the story is that now you have a 1% floor that's been introduced effective 1/1/26 by the One Big Beautiful Bill, which means that the first 1% of your taxable income is not deductible. For all practical reasons, reduces your 10% deduction to 9%. The design was, to encourage high-intent purpose-driven giving, but it came with a price and it has some cascading effects, which we'll share with some examples in the upcoming slides. So this slide shows, the key differences between a charitable giving and a business expense, and why it matters. So the purpose of a charitable giving is, you give to a qualified organization, there's no substantial benefit or return to the donor. Versus if it's a business expense, you have to substantiate the business purpose. You have to demonstrate some kind of direct business benefit. It could be, your PR strategy, your marketing, something that you boost to boost your employee morale, or, just retention in general. But why is it important from a tax planning perspective is the last 4 things that we're going to talk about. Charitable contribution is limited to 10% of your income versus business expenses deductible in full. Now, the OBBBA twist, we talked about the 1% floor, so it becomes even more, aggressive or brutal if you are a charitable contribution. The 10% now reduces to practically the 9%. And there's no floor limit for business expense. There's a carry forward period for 5 years for your unused charitable contributions or donations, which is not quite applicable to business expense because everything is deductible in full. Also, if you are a loss-making company, it doesn't apply to you. And if you give any donations, you're not able to claim any tax benefit on that. Versus if it's a business expense, it gets filled into your net operating losses, which can get carried away indefinitely. So now we know that the business expense may be a little bit more beneficial from a tax planning perspective. And what drives the tax treatment is 3 key components: intent, control, and benefit. If you're donating to an organization, a charitable organization, that's your intent, it's a charitable treatment. Whereas if it's business driven, simple, it's a business treatment. If it's controlled by, somebody outside the organization, like a charitable independent charity, it's charitable treatment. Versus somebody, if the company management controls it, it's a business treatment. Third thing is, around the benefit. Like you have to, for charitable giving, there's no benefit in return, like it's intangible. But you can have in documents some tangible, measurable, returns that you get out of a donation that you're making. Like you're making a donation to a gala, a foundation, but if you have employees coming there, or you have business partners or competitions in there, you can showcase that there's a brand awareness, there's a goodwill that you're creating, or maybe it's helping with your in their numbers that can support like employee retention before and after the event, or doing more of those events. How does that help support your business and aligns with your long-term business vision is what makes it business expense under Section 162. And why does it matter with the 1% floor? Here are a few examples. Like because say you have a 50 million taxable income, your 1% floor is going to be consistent at $500,000. So if you give anything below that limit, like in our first example, say $400,000, you get zero deduction. But if you're giving, say, even less than that, $200,000, but spread over 3 years, you still don't get a deduction because you don't get past the 1% floor mark. But if you bundle it up and donate, say, $600,000, you'll now pass the 1% hump, and you get some deduction, and the remaining gets carried over. It's good that you're getting some benefit, but if you have a flat business model and you're making the same, say, taxable income every year, that's what the forecast says, and you're planning to contribute the same amount of money every year, a short story is that you will not be able to get that, we use that unused charitable contribution that you carry over every year within the next 5 years. Whereas the business expense, it's not dependent on your taxable income. You donate $300,000, you get a tax benefit of $300,000 right in that particular year. It also not just impacts small businesses, it impacts big businesses. Like if you have $200 million of taxable income, and you donate $5 million, you get only a deduction above the 1% floor, which is at $2 million. So instead of getting $5 million as tax deduction, you get only $3 million, the remaining is carried over. So the impacts would be huge, and that's why planning ahead, the CSR leaders aligning their strategies with the finance leaders and modeling it out is the key. Also, employee matching gifts, are subject to the 1% floor. So it's not just what the employee is giving, but if you're matching, the employee is matching your donation, giving as an incentive to the employee, even that is subject to the 1% floor, unfortunately. But at business expense, if you are supporting, say, business employee assistance or hardship programs, or sponsoring a gala event or PR event, a marketing event, can all technically fall under a business expense. For a business purpose, the agreement should, there's some ways that you can showcase why could be treated as a business expense, and some of them could include that as a sponsorship in your sponsorship agreement, that you state that it is for marketing purpose. They could be, you can take pictures around it and show and beef it up with additional evidence that you had employees, in that event attending, or competitions. You got introduced to somebody that helped you, grow your business during that event. So something that's tangible and measurable and showcases how it helps boost up your business from that event. Things to avoid, don't go too crazy, avoid lavish arrangements, and also if you have somebody in your executive committee, be part of the gala or charity, the board, then that doesn't sound, it's more personal and it's not a business expense. And if you've treated a similar event or expense as a charitable contribution in the past, then you have to be consistent. Again, it's effective 1/1/26. So companies still have time between now and 12/31 to follow the old rules, which did not have the 1% floor. So go all out for donations if that's something that helps you maximize your tax benefits, and also optimize corporate giving strategies. It gives you full deduction. You're not subject to the 1% floor, assuming it's less than 10% of your taxable income, and aligned in with your cash flow impact long term. So again, the key is going to be for CSR leaders and finance leaders to constantly communicate. The last slide is just about this is a tax person talking. These are all the tax effects, but definitely there are intangible benefits about giving. So don't stop that. It helps build your brand, helps with your employee engagement, helps keep your customers happy, investor relations. There's a lot of intangible impact from corporate giving. So keep doing what you do. Just think ahead and think if you are able to save some dollar value, cash dollars along the way. With that, I would sign off and hope you all have a wonderful rest of the week.